Industry Canada maintains a tool to create financial performance data by industry or occupational group. According to their overview,
financial performance data provides access to more than 1,000 industries across Canada, including more than 30 performance benchmarks, to help small businesses determine how they measure up to their competitors. Reports feature the number of businesses in the selected industry or occupational group, statistics for profitable and non-profitable small and medium-sized businesses that include net profit or net loss, detailed financial data on revenues and expenses, and industry averages for income statements. The reports represent all businesses operating within the specified industry and geographic area and earning revenues ranging from $30,000 to $5 million and $5 million to $20 million in total annual revenues and by profit margin. In 2022, there were 17,073 offices of accountants with less than $5 million in revenue and only 109 with between $5 million and $20 million. Since SBA Canada is focused on small business, we are primarily interested in the smaller market segment. Industry Canada derives their financial performance data from personal and corporate tax returns, which began requiring the use of the General Index of Financial Information in 1999. In essence, this standardizes financial reporting of business income for tax purposes. While corporate data is more complete, it is harder to interpret since profit is net of wages paid to principals. So we looked instead at income statement data from Form T2125 of the personal tax return. This data is derived from returns for 3,676 firms, representing about 21.5% of the entire population of smaller accounting firms. T2125 data is fairly representative of the population of firms, though these firms do skew smaller. Most important, it has the advantage of being easier to understand since net profit represents the income of the principal or principals.
first we looked at the offices of accountants with less than $5 million in revenue. This segment of the market includes about 99% of firms. The population is broken into quartiles by profitability. For us, the most striking feature is that profitability increases in an inverse relationship with labor costs. Remember that the profit includes the earnings of the principal or principals. Revenue, on the other hand, seems to decline as profit increases, at least when it comes to the bottom 75% of firms in terms of profitability. We believe that the most profitable quartile includes a large number of partnerships. In the case of partnerships, both total revenue and net profit on Form T2125 is calculated at the partnership level. A large percentage of the most profitable firms likely includes the income of 2 or more partners. Another factor that would tend to increase revenues is the specialization in technical areas of taxation. This should tend to increase revenues and limit the ability of these firms to subcontract to generalists without specialist skills. A great many accounting practitioners are aging out and looking to retire. There is a mismatch between the skills of today's business school graduates and the needs of accountants in practice. The problem is exacerbated by the new CPA competency map introduced in 2021, which ignores the real needs of more than 90% of Canada's businesses who actually value the services of these practitioners. Business school curricula are based on the wishful thinking of Canada's colleges and universities, and their accomplices in Canada's accounting regulatory bodies who pay lip service to concepts like product market fit and haven't yet faced Canada's new demographic realities.